Hello everyone. Thank you for tuning into the COVID interview Capital Markets segment. My name is Oliver, and together with me is my learned friend Joshua. Today, we have invited Ms. Connie Heng to share some insights with us on how COVID-19 has impacted the capital markets. An alumna of NUS Law, Connie is based in Hong Kong as a partner at Clifford and is currently serving as the head of Clifford capital markets practice in Asia Pacific. During her 20-plus year career, she has assisted many Hong Kong and Chinese issuers with their security offerings in the international debt capital markets and has advised on numerous landmark transactions. She is recognized as a leading individual by Chambers Asia Pacific and Legal 500 and has received a highly regarded ranking from IFLR 1000. Connie is a member of the firm's global wider leadership group and has represented the firm as part of its delegation to the World Economic Forum in Davos since 2012. We are also ecstatic to hear that Connie will be taking over as regional managing partner of Clifford Chance Asia Pacific practice coming November this year. With her years of experience, we are sure that Ms. Heng's insight into how COVID-19 has impacted her industry will be invaluable. A very warm welcome, Connie, and thank you for joining us this morning.
Thank you both. I'm delighted to be on this Zoom session. Some of you may know I graduated from NUS and I spent 4 fabulous years at NUS Law School. And so I'm really delighted to be able to do this together in collaboration with the NUS second year students. So yeah, I'm extremely happy to be here.
Ms. Heng, the pleasure is ours. And in today's interview, we'll be talking about both debt and equity markets and how COVID-19 has impacted these sectors from a legal perspective. So to start the ball rolling, Ms. Heng, why don't you tell us about how COVID-19 has impacted the legal industry and particularly your work in capital markets?
Thank you. Well, maybe I should start by saying that COVID-19 has been a seismic event that no one has planned for. No one had planned for the speed at which it would hit us, and no one thought that it would be so persistent and it's still around. So it's been very disruptive for everyone, not just for the companies, for markets, for companies looking to raise finance, but it's also affected our daily lives. It's also probably why we're doing this interview on Zoom rather than maybe meeting in person to do an in-person interview. So for the legal industry, it's really an unforeseen disruptor. Now, lawyers, I can say so for myself, lawyers don't like change. We don't cope very well with change. But lawyers, like everyone, has had to adapt. The legal industry has all along been a fairly traditional one. What do I mean by that? A law firm, firms in the legal industry, we're a professional services firm. Now, relatively speaking, we're still fairly traditional in that we value physical meetings. Lawyers sit in the office to produce documents, to do drafting. So the deliverables are produced on site in an office. And lawyers love paper. We love printing paper. We love reading from hard copies. At least my generation, and maybe the 2 students who are doing the interviews today, I look at things slightly differently. And we were not very good with working on the move. Then COVID came and many lawyers and indeed many professionals at the workplace have had to work from home, not by choice, but by circumstances. And what that means is maybe the printer isn't as accessible. You're not able to see your clients, see your colleagues face to face, to have discussions, to have meetings. So we have been forced to rethink some of the normals and the challenges that come with it. So I guess, you know, what it has also then shown us is that the investment that we have made as a firm in technology is really important, because to be able to function and deliver legal services to our clients, we've had to rely a lot on technology, on Zoom meetings, on phone calls, on electronic delivery of documents. And we've had to be pretty agile in terms of where we work. And firms that have made the right investments in technology would find that actually their workforce, the lawyers, the professional services staff, business services staff, have been able to very seamlessly continue on with execution of transactions, for example, carrying on of meetings fairly seamlessly at the same speed and as higher in efficiency, sometimes even more efficient. So there are certain winners and losers out of this. So I think it's been very disruptive, and that disruption keeps ongoing. Now, maybe looking at the capital markets and zooming in on sort of my area, maybe taking a step back, the capital markets, by way of introduction, is a market where companies, issuers of debt and equity look to raise finance. And it's a culmination of varied investors, many different types of investors who come in with different channels of funds and capital available. Now, the capital market is also very interesting. It's driven by a few things. It's driven by sentiment. It's driven by the debt capital markets, driven by interest rates, whether the interest rates are high, they're low, and by fundamentals of the company, so the industry that the company is in. So really three big areas. There's also another area which is regulatory and government policy, which I can also touch on. So you have seen that the interest rates and treasury yields have remained low. And so, you know, I guess prima facie, that should be good for companies looking to raise debt. So maybe looking at this year, just looking at this year, we saw COVID-19 hit Asia, China first. And so for the first quarter, from January to March, early part of March, the global investors probably thought that and the markets felt that the COVID-19 was probably more of an Asian issue, fairly contained within China and Asia. So the markets were still fairly confident and they kept going. They were fairly buoyant in the debt and equity markets. Then came March, so Q2, end of Q1, start of Q2, when it became, slowly people started to realize that it's going to be a global pandemic. And that's when the market started being very turbulent. I mean, if you look at the curves in the stock market, in the bond markets, you see sharp dips around February, March, and then it started going up in a different trajectory again. So Q2 this year was slightly more challenging in that investors were hit by a sense of uncertainty of where it was going to go. You know, we're going to find a vaccine. How long is this going to be? Then came Q3, which, you know, was just started in July, and the market started to recover because people felt this was the new normal. And combined with the continuing low interest rates in the market, that was very favorable for companies. So then we look at the fundamentals of the companies and the issuers looking to tap the market. You'll see that companies that are in the traditional industry, for example, like food, and tech companies, e-platforms, they are companies that people believe in this current environment are good industries that will be quite probably quite COVID resilient. In fact, will thrive on the current use of technology and electronic platforms. So just over the last few months, we saw companies like JD.com, that's a very big Chinese e-retailer. And just today, Yum China announced a IPO on the Hong Kong Stock Exchange, a secondary listing. Yum China is a company that runs Pizza Hut and KFC in China. So food companies. Then we also saw XPeng, which is XPeng, that's an electronic vehicle company, raised money on the NASDAQ in the US on the IPO market. So you see that the investors are looking at companies with strong fundamentals, fairly COVID resilient, or actually will thrive on COVID, or looking forward at the future of how we're going to live. And these are the companies that actually find it quite easy to raise debt in the current environment. Now, then we go back to what I mentioned earlier in my area, debt capital markets, central banks keeping interest rates fairly low. And so when sentiment came back in Q3, end of Q2, beginning of Q3, we saw a pickup in activity in the debt markets again. And companies which had plans to raise debt, but were a bit worried about uncertain market volatility, they came back with a vengeance, and we saw a lot of deal flow. So, in terms of what it means for us as a law firm and as lawyers doing capital markets transaction, this year has been lumpy, right? So it's like feast or famine. You could be very busy because everyone's sentiments come back, and companies wanted to catch the wave of a positive market sentiment. And deals will rush out and lawyers become very busy, but there are also periods then that you are very quiet. So it's been a lumpy period for us. So our lawyers have had to embrace fairly agile working, meaning you work when actually things are very busy, finish the transactions off with the clients, but when things are quieter, you can sort of take a bit more of a breather. Now during COVID, we've also had a deeper think around how we can use technology to improve in the delivery and make lives a bit easier for our associates and for our clients, and redesigning our deal delivery processes. So in terms of deal execution, maybe talking a little bit deeper into capital markets and just taking, for example, debt capital markets. As part of deal execution, traditionally the lawyers did everything from drafting to printing, to sending the documents out. So from start to finish, that whole process was done by legally trained lawyers. And breaking down the deal execution into phases, we have at the start of the capital market transactions, due diligence, where we undertake due diligence on behalf of our clients, whether we act for the underwriters of the financing or we're acting for the company looking to tap the markets. Then we also do the document preparation, and the documents can vary depending on what market you are tapping. So in terms of legal documents, we would prepare legal documents, we would prepare the offering document, which you call a prospectus or an offering circular for debt or equity. And then there's the stock exchange listing, and then we close the transaction. So there are essentially 4 or 5 large phases. Now, what do I mean by having to think about redesigning? So at Clifford Chance, we've thought long and hard about how can we improve these processes to make it more efficient, to take out some of the more mundane tasks that's involved in the deal execution, and let our lawyers, free up our lawyers' mind to do the value add, to do the thinking, the more interesting parts of the job, but also incorporate support from tech, from software, and from other functions, non-legally trained functions who can help speed up the processes. So let's take due diligence, for example. If the due diligence is a big piece of the work, there's a lot of due diligence to do. We have tech software that can help us with some of the initial document review. And indeed, in the document preparation stage, we also are able to have, for example, in terms of the prospectus drafting or the offering circular drafting, some of the more mundane tasks like, checking, proofreading, checking for pagination, checking for formatting, those tasks can be delegated to our legal support center. We have a very big legal support center that are supported by lawyers sitting across the region. We have support in China. We have support also in India, Legal Support Services Center, who can help with some of the more basic tasks to allow lawyers sitting in our offices in Hong Kong, Singapore, Tokyo, Australia, to free ourselves up to focus on the actual legal drafting, for example. So stock exchange listing. So for a debt transaction, often the debt and the bonds are listed on the stock exchange, be it Singapore or Hong Kong. Now, there are some parts of the listing which require talking to the stock exchange to get their feedback, but certain parts of the listing are fairly mundane. So, filling out the listing application form, for example, great for the lawyers to do it once, twice, but perhaps not 10 times. So some of these tasks actually devolved into other functions within our practice area, such as the paralegals or our practice support coordinators. Then at closing, again, we use technology. We have a software that we developed in-house called CC Transact, and that has allowed us to use technology to put all the documents onto a platform. So in transactional practices, often we have things like completion, where in the old days, when I was growing up, the partner says, go and book a meeting room. So you run to the receptionist and you say, I need a meeting room for a whole day. Now, what do you use a meeting room for? You collate and you tidy up these bundles of closing documents. These are all condition precedent documents. So documents that must be in place before a transaction can close. So it could be things like board resolutions. The company needs to approve, the board needs to approve the transaction. So that's got to be a copy that's signed that you cite. Then that could be the stock exchange application, listing approval. And it could be certificates from directors or officers of the company certifying certain things. So these are what we call condition precedent documents. In the old days, hard copies were placed in meeting rooms around a long meeting table, and then people, lawyers from both sides come in and inspect them, and then you confirm to the client. We have all the CPs in place and we can close, right? But these days, we do it virtually. So on our platform, there is a virtual meeting room that we call CC Transact, where documents can be uploaded and our clients can look to see what real time when the documentary CPs are satisfied. And what's even better, at the end of it, at a click of a button, once the transaction is done, we can produce a deal Bible. So a deal Bible is really a binder of all the closing documents, because companies or the banks or ourselves, we will want a record of how this looks. And even better, we don't need to print it out. We store it on the platform. So it's gone paperless. So with these tools that we've invested in over the years, with COVID, it's really come to bear as to how we can do work so much more efficiently in a paperless way without having to meet in person in a meeting room. Now, it's been quite interesting for us to see that some of the investment that we've made have come to bear. And for clients, just maybe touching quickly on the client side, how has it affected clients looking to do a capital markets transaction? I would say it's a nightmare, because for companies looking to raise debt or indeed raise equity, for them, certainty, they don't like volatility. They want certainty of when a deal can launch, because they might have a financing that's coming due that they need to refinance. In July, COVID hits, they are worrying, they're sweating. Can I raise money to refinance? So it's not been great in terms of planning. And yet they look at the markets, the yields are low, and it's a great year to tap the market, but they're not sure with the bad sentiment earlier on in the year whether they could pull off a successful deal. Now, there are other issues that they need to navigate. So if I'm a treasurer of the company or CFO, the window for tapping the capital markets isn't very long. It's not a whole year, because if I'm a listed company, especially, I have to navigate around my blackout periods. What I mean by blackout periods are things like the annual report release, interim report release, two main events, and also navigate around certain price sensitive information disclosure. So a lot of companies in the retail industry or in the hospitality industry, they've had to issue profit warnings telling people, look, our annual results were fabulous at the year end last year, but hey, don't expect us to do anything that great for the interims, because the first 6 months, our hotel occupancy rate was 5%. So they have to navigate around these difficult issues. So really for a treasurer or CFO, the window at which they can tap the markets is really only about, I'd say, between 6 to 8 months in a year, between February and end of June, perhaps, and then again from about August, September to around November, because December traditionally is a quieter month, because investors are sort of starting to take holiday with Thanksgiving in the US and Christmas holidays at year end. So, with the 8 months and in between, there could be profit warnings. It's a nightmare, because then there's market volatility. It has not been fun for our clients. Now, then I guess, I can also talk a little bit about what are some of the tactics that people are looking to use to try and overcome this volatility. I mean, there are things that they can do, such as for frequent issuers of debt, they can look to set up a framework program of bond issuance so that it speeds up with the execution, and they could just do a drawdown under the MTN or framework program. So then again, also on the marketing of the bond, when they actually eventually embark on a roadshow to see clients and sell their wares, we have seen that what has traditionally been face-to-face meetings, roadshows with clients, with investors. So these are meetings where companies would meet potential investors face-to-face and tell them about the company and explain why they're raising funds. These have had to change from face-to-face one-on-one meetings to virtual online roadshows. So right at the beginning of COVID, we had to, as a firm, advise clients on how they could change, what are the potential risks with virtual online roadshows and how to navigate these risks, because this is inevitable. And so far, a lot of trades, in fact, probably 99% of the trades that we're seeing in Asia in the capital markets are done virtually on virtual roadshows.
Thank you, Connie. Perhaps to go into greater detail into raising debt specifically, in these uncertain times, are there perhaps good opportunities, even for the so-called losers in this crisis? Given this this double window of the early part of the year, the later part of the year, are these still good opportunities for the so-called losers?
Yeah, I think I think in every crisis or every challenging situation, there will be risks, but there will also be opportunities in the risk, right? So I mentioned earlier on some of the strategies and some of the opportunities that can be used, tactics, for example. Mm-hmm. In the debt markets, for companies that want to, because with volatility, what you want to be able to do is make sure you've prepared all the legal documents, done all the groundwork, and be able to tap the market or tap the window, as they say, grab the window, market window. The market window is a window where investors are bullish and fundamentals are good, rates are low, and company wants to go in. But they can't go in if they're affected by blackout period, they're affected by the documents not getting ready. So speed of execution, getting things done is very important. So I mentioned, there are opportunities around companies setting up note issuance programs so that documents are done and there is then very little left to do other than to update the due diligence, get the drawdown documents in place, and off they go. So this is obviously one thing that treasurers and CFOs can think of. It's very helpful to help them break into the market quickly, and very helpful as well if they're going to be seeing, they're going to be tapping the market multiple times in the year. Now, for companies who are more mature and they have tapped the markets a few times, they should be looking, in this low rate environment, at their maturity profile of their debt. So, now is a good time to be issuing longer term debt at a cheaper rate, to do a replacement of short term debt for a longer term debt. That gives more certainty to the company and a funding base. For companies who have issued a lot of debt, some of them might be worried about their debt to equity ratio. This is important for a company because there might be pressures from the rating agencies. So rating agencies rate a company and they give it a rating like single A, double A, triple A, single B, double B. And ratings are a very important part of the debt capital markets because it is seen as somewhat a more independent assessment of the company's creditworthiness. Now, rating agencies will look at the company's different financial ratios, the amount of debt, the amount of equity. So some companies also take this opportunity to issue what we call hybrid capital. So the hybrid capital looks somewhat like debt, but it also looks somewhat like equity. The beauty of this instrument is that it can be treated from an accounting perspective as equity. So from the balance sheet perspective, the company looks, the balance sheet looks pretty nice because it doesn't all go into debt when they issue a bond. When they issue a hybrid instrument, it goes into equity. And that helps with their ratio management. So you'll see that there are quite a lot of companies that have taken that opportunity to issue hybrid capital, perpetual securities, and we've seen quite a lot of that over the last few months, especially in Q3. Then you have also then the maybe slightly lower companies with lower ratings or sub-investment grade companies, or indeed companies that haven't got the rating, but actually they have a strong need for refinancing. Now, I think this is also a good opportunity for them to look at different segments of capital. So not just in the public markets, like what I've mentioned just now, but also in private placement market, club deals, smaller deals where, you know, there are only a few investors, might be more structured. Investors might be asking for a bit more belts and whistles in terms of credit enhancement, but those can still be done. And then I guess there is also then the loan markets that they can be looking at. Yeah.
Thank you for your insights, Ms. Heng. It's comforting to hear that there's still a silver lining to the economic crisis. Perhaps to close on a lighter note, could you please share with us some advice you would give students looking to develop transactional work in these different times?
Yes, time flies quickly when there's a lot to say. So I think you asked the question, you know, what should students be looking at when they're thinking about a career in transactional work? Transactional work covers a wide area. So, you know, from finance, capital markets, corporate M&A, there are a lot of similar themes that come through it. Now, a lot of law firms are embracing technology and looking at legal tech, looking at how technology can help with the execution of transactions. So I think that I mentioned earlier that, you know, in our team, at least in our firm, there is a whole function that work alongside and collaborate with the lawyers to deliver the product. So we have legal project managers, we have practice support coordinators, we also have legally trained individuals who are looking at the work design, the workflow design, for example, and we also have at Clifford Chance a subsidiary called Clifford Chance Applied Solutions. Let me just very quickly touch on that. This is a subsidiary that develops software, or actually come up with a product. I shouldn't say we don't develop software, but we come up with a bot or a product that helps the clients for some of their internal requirements. So for example, let me just give you an example. We have lawyers who are also coders, and these lawyer coders sit in Clifford Chance Applied Solutions, and they come up with software products. One product we're very proud of is a compliance tool, which our banks, especially in Europe and the UK, they have certain compliance obligations to their regulator. And this software allows them to keep track of what that obligation is and where the status of it and what they need to be doing, what they haven't done. Now, in the old days, how it would have worked is somebody at the bank would have called us up, everything is done manually. But with these software solutions, it helps the clients actually, without so much face time and also saving, you know, with the upfront investment in the product and the solution, they can actually do a lot of things in-house. So what that means for lawyers and students developing a career in transactional work is actually to broaden your mind. The days of master disciple alongside each other, drafting, speaking face-to-face, doing, for younger lawyers, doing everything from start to finish of a transaction, basic tasks, multiple times through to the fruition of a transaction. I think that is now gone. And I think lawyers looking to develop a career in transactional work should be more open-minded in terms of the different tracks, different career tracks that you may have in a law firm. With us at CC, we do have a training program that we rolled out last year, which has a focus on technology. So part of the time is spent on technology and thinking about tech. So I think that's incredibly exciting. I certainly didn't have that when I was growing up. So the legal industry is changing fundamentally, and I think this is a positive development for, you know, young talented individuals like yourself, where you don't just need to be sitting there drafting 8 hours a day. You could be developing a bot. you could be thinking about how we can be more efficient in service delivery.
Connie, it's been a real pleasure having you on board with us for this project, and I've enjoyed every single bit of the interview. Thank you so much for your valuable time, telling us about capital markets and how COVID-19 has impacted this industry and the larger market as a whole. And from all of us at NUS, we hope to see you one day on our campus again. We'll give you a good tour. And yeah, thank you so much once again.
It's been my pleasure. Thank you very much. Thank you.